All right, something big just happened in silver, and if you blinked, you probably missed how fast this thing flipped. We're talking about a 25% rebound in just days, from roughly $71 to flirting with 90 again, and it didn't come out of nowhere. While Western markets are hovering around 90, Shanghai spot is sitting near 104. That's a $14 to $15 premium, about 16%, screaming physical stress. Both futures volume and Shanghai pricing just confirmed it. Stay with me because I'm going to show you why this matters right now, how this pattern works, and how you can spot it next time before the crowd does. Before I explain what caused this move, let me teach you something most people don't really understand about markets like silver. Price isn't just emotion, it's plumbing, it's pressure. Think of the market like a spring-loaded door. Leverage pushes it one way, margin rules slam it shut the other way, and physical demand is the weight leaning against it nonstop. When leverage gets too extreme, exchanges hike margins. Weak hands get forced out, and price crashes fast. But once that forced selling is done, the door doesn't just stay shut. Pressure builds, buyers wait. And when selling exhausts itself, price snaps back harder than people expect. That's not hype, that's mechanics. And once you see that, you start realizing crashes aren't always bearish. Sometimes they're the setup. Now here's what most people miss. They see a price crash, and they think the market is telling them something fundamental changed. But what if I told you that sometimes the crash is the market's plumbing breaking, not its foundation cracking? See, futures markets run on leverage, and leverage is controlled by margin requirements. When prices move too fast in either direction, exchanges raise those margins to protect themselves. Sounds reasonable, right? It is. But here's the catch. When they raise margins, traders who were leveraged 10 to 1 or 20 to 1 suddenly need more cash to hold their positions. If they don't have it, they're forced to sell. That's not discretionary. That's mechanical. And when enough people are forced to sell at the same time, price doesn't drift lower. It collapses. So what does that tell us? It tells us that not all selling is created equal. Some selling happens because people change their minds about value. That's fundamental selling. But some selling happens because the rules of the game changed mid-play. That's mechanical selling. And the difference matters because fundamental selling can persist. It can build. It can reflect real problems. But mechanical selling exhausts itself. Once the forced liquidations are done, once the weak hands are out, the selling pressure just stops. And if demand is still there, if the physical market never actually broke, then price doesn't slowly recover. It snaps back, fast, violently, and it catches people off guard every single time. If this is making sense so far, drop a comment and let me know you're following along. Because what I'm about to show you next is how this exact pattern just played out in silver, and why the people who understand this are positioned very differently than the people who don't. Now here's what's actually happening in silver right now. Last week, CME margin hikes triggered forced liquidations. That wasn't discretionary selling. That was sell now or else. Price dumped hard into the low 70s. Shorts got emboldened. Longs got wiped. Open interest collapsed. That's phase one. The mechanical flush, the forced liquidation, the spring-loaded door getting slammed shut. And everyone who doesn't understand market structure looked at that and said, see, I told you silver was done. I told you the rally was over. But here's what they missed. Phase 2 kicked in. Physical buyers never left. Shanghai never collapsed. In fact, Shanghai held above $100 while Western paper markets panicked. Let that sink in for a second. While futures traders in New York and Chicago were liquidating positions at $71, $72, $73, buyers in Shanghai were still paying over $100. That divergence matters because it tells you the physical demand didn't break. The paper structure broke. The leverage broke. But the underlying bid from people who actually want the metal, that stayed firm. So when futures stabilized and selling pressure faded, buyers stepped back in aggressively. Futures started rising. Volume expanded. And that Shanghai premium started acting like a magnet, pulling Western prices higher. Think about the physics of that for a second. If you can buy silver in New York for 90 and sell it in Shanghai for 104, what are you going to do? You're going to buy in New York. You're going to ship it east. And you're going to capture that $14 spread. That arbitrage pressure doesn't care about sentiment. It doesn't care about technical levels. It just cares about the price differential. And as long as that premium persists, it creates a floor, a pull, a constant upward bias on Western prices. Here's what's wild about this. Shorts that thought they were safe after the crash are now leaning the wrong way again. And they're leaning into rising prices. See, when silver crashed into the low 70s, a lot of traders went short thinking they were catching the top of a dead cat bounce. They saw the liquidation, they saw the panic, and they assumed the path of least resistance was lower. But they misread the setup. They confused mechanical selling with fundamental selling. And now they're trapped. Because if price continues higher, if 90 holds and 95 breaks, those shorts have to cover. And when shorts cover into rising prices, it accelerates the move. But here's the part that should make you nervous if you're not paying attention. If 90 holds and 95 breaks, that's when momentum traders pile in. Not fundamentals traders, not value investors, momentum traders, the algos, the trend followers. The people who don't care why it's moving, they just care that it is. And that's how squeezes accelerate. That's how moves that look reasonable suddenly go parabolic. Because once momentum kicks in, once the technical levels break, the original catalyst almost doesn't matter anymore. The move feeds itself. Now let me show you what very few people are talking about right now. Futures volume. Volume tells you intensity. It tells you conviction. It tells you whether money is actually backing the move or whether it's just noise. And here's what we're seeing. As silver rebounded from the low 70s back toward 90, futures volume didn't collapse. It expanded. That's confirmation. Because if this were just a short covering bounce, a technical relief rally with no follow-through, you'd expect volume to be thin. You'd expect light participation. But that's not what's happening. Volume is building. And when volume builds on a rebound after forced liquidation, it tells you new buyers are entering, not just old sellers exiting. So now you've got three things converging. You've got Shanghai premiums holding firm, signaling physical demand never broke. You've got Western futures rebounding with expanding volumes, signaling new money entering. And you've got shorts positioned wrong, creating fuel for a squeeze. That's not one data point. That's a confluence. And when you see confluence in markets, when multiple independent signals all point the same direction, that's when probabilities shift heavily in your favor. This is the exact same playbook we've seen before. Go back to 2011. After silver's initial crash from near $50, margin hikes flushed leverage. Everyone declared the move over. The media ran stories about the bubble popping. Retail traders capitulated. And then what happened? Silver ripped higher in violent multi-day rebounds that overshot expectations. It didn't go straight back to 50, but it didn't stay dead either. It caught everyone leaning the wrong way and squeezed them hard. Same pattern. Forced liquidation, premature bearishness, mechanical rebound. Or look at March 2020. Remember that? Everything collapsed. Stocks, bonds, commodities, crypto didn't matter. If it had a ticker, it sold off. Silver got crushed along with everything else. Futures hit $12. People were calling for single digits. The forced liquidation was brutal. Margin calls everywhere, but physical demand never disappeared. In fact, physical premiums exploded because dealers couldn't get inventory. Mints sold out. Retail buyers flooded in. And once the selling pressure exhausted, once the liquidations cleared, silver didn't slowly grind higher. It ripped from 12 to 30 in less than 5 months. 150% move. And it shocked everyone who thought the lows would get retested. Same thing in 2023. We saw a sharp correction in silver after a decent run. Margin hikes came in. Liquidations followed. Price dropped hard, and then it snapped back fast, catching shorts off guard. Every single time this pattern appears, the rebounds are sharper than logic says they should be. Why? Because positioning resets faster than belief. The weak hands are out, the shorts are in. And when price turns, there's nobody left to sell, and everyone needs to cover or chase. When you zoom out, you see the pattern isn't about predicting exact prices. It's about recognizing when selling is mechanical instead of fundamental. And every time you can make that distinction, every time you can separate forced liquidation from genuine bearishness, you gain an edge. Because the crowd always confuses the two. They see price collapse and they assume something broke fundamentally. They don't ask why it collapsed. They don't look at margin changes or open interest. They just react. And that reaction creates the opportunity. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this fail? Of course. Shanghai premiums can compress. If arbitrage flows increase, if supply routes open up, if Chinese demand weakens, that premium could narrow fast. And if it does, one of the key supports for this move disappears. Futures volume can stall. If we see volume plateau or decline as price rises, that's a warning sign. It means the move is losing participation, losing conviction. And without conviction, rallies don't sustain. 90 could break instead of hold. If price fails to defend 90 and rolls back into the 80s or lower, the bullish structure breaks. The shorts win. The rebound thesis dies. And yes, silver is manipulated in the sense that leverage rules shape price. Central banks hold gold. Big banks hold futures positions. Exchanges change margin requirements at convenient times. All of that is real. But here's the thing. Manipulation doesn't cancel physics. It just changes timing. You can argue about motives all day long. You can debate whether the powers that be want silver lower or higher. But it doesn't actually matter for your decision making. What matters is what you can measure. Price levels. volume expansion, premium persistence. Those don't lie. They either confirm the thesis or they don't. Instead of getting caught up in conspiracy debates, focus on what you can control. Can you measure Shanghai premiums? Yes. Are they holding or compressing? Can you track futures volume? Yes. Is it expanding or contracting? Can you identify key support levels? Yes. Are they holding or breaking? Those are the questions that matter, not whether some bank is suppressing price or some government is hoarding metal. Trade what you can verify, not what you can theorize. There are probably 3 types of people watching this right now. Maybe you're already long silver, maybe you bought in the 80s or 90s, maybe you've been stacking physical for years, and you're wondering if this move is real or just noise. For you, the key is not getting greedy too early. Watch 90, watch 95. Let the market prove itself. If 90 holds as support, if 95 breaks with volume, then you've got confirmation. Then you can add. Then you can hold with confidence. But if 90 fails, if we see a breakdown, don't marry your position. Be willing to reassess. The market doesn't care about your thesis. It only cares about what's actually happening. Maybe you missed the bounce and you're feeling frustrated. You saw silver at 71 and you didn't pull the trigger. Now it's at 90 and you're kicking yourself. That's normal. Every trader has been there. But here's what you need to understand. Patience matters more than prediction. If this move is real, if the structure supports higher prices, there will be pullbacks. Markets don't go straight up. They breathe, they consolidate. They give you second chances. So instead of chasing here, wait for a pullback that holds a higher low. Wait for 85 to act as support when it used to be resistance. That's your entry. That's your lower risk opportunity. Don't chase momentum. Wait for structure. Or maybe you're skeptical. Maybe you're sitting in cash, waiting for confirmation. Maybe you think this whole thing is just a head fake. That's valid too. Not every rebound turns into a rally. Not every squeeze sustains. For you, confirmation means Shanghai staying above 100 while futures volume expands. It means 90 holding as support on a retest. It means seeing follow through, not just a one-day pop. If those things happen, you've got your signal. If they don't, you avoided a trap. Different approaches, same principle. Don't trade opinions, trade structure. So here's what I want you to answer in the comments. Which one are you? Are you long and managing? Are you frustrated and waiting? Are you skeptical and watching? Because understanding where you are mentally helps you make better decisions. It keeps you honest. It keeps you from lying to yourself about what you're actually doing versus what you think you're doing. Here's where I stand. I'm not predicting a number for clicks. I'm not telling you silver's going to 120 or 150 or 200. I'm watching signals. Let me tell you what I'm personally watching. First, I'm watching whether 90 holds as support. If we see a retest of 90 and it bounces cleanly, that's a major confirmation. It tells you the liquidation lows are in. It tells you buyers are defending that level. But if 90 breaks, if we close below it with volume, the bullish case weakens significantly. Second, I'm watching for a clean momentum push through 95 with volume. 95 is resistance. It's where shorts are likely defending. It's where breakout traders are waiting. If price pushes through 95 and volume expands on the break, that's when the squeeze potential activates. That's when algos notice. That's when trend followers jump in. But if we see multiple failed attempts at 95, if price keeps getting rejected, then we're range-bound, not trending. Third, I'm monitoring that Shanghai premium like a hawk. As long as Shanghai stays above 100 and Western prices stay below 95, that spread is creating pull. It's creating arbitrage pressure. It's supporting the floor. But if that premium compresses, if Shanghai drops to 98 or 96, the game changes. The magnet weakens. The support diminishes. So I'm watching it daily. Not just the absolute price, but the differential. Based on my analysis, this move wasn't random. It was mechanical. The forced liquidation phase is fading. Physical demand never left. And the reset is pulling price higher. The fundamental picture hasn't changed in the sense that global debt is still expanding. Monetary policy is still loose. Industrial demand for silver is still growing. And supply constraints are still real. What changed was leverage. What changed was positioning. What changed was the mechanical structure of who's long and who's short and at what levels. If history rhymes, and if silver can hold above 90 and push through 95 with conviction, the move that follows could target triple digits. Not because I'm calling it, but because that's what the pattern suggests. That's what the mechanics imply. Every time we see forced liquidation followed by persistent physical demand and expanding futures volume, the rebounds overshoot. They don't just recover, they squeeze, they trap shorts, they attract momentum, and they run further than the fundamentals alone would justify. Now, I'm not a financial advisor. This is not financial advice. I'm a guy who studies markets, who watches patterns, who tries to separate signal from noise. You need to do your own research. You need to verify everything I've said. You need to make your own decisions based on your own risk tolerance and your own financial situation. Don't take my word for it. Don't take anyone's word for it. Look at the data yourself. Check Shanghai premiums. Track futures volume. Watch price action. And then decide. If you made it this far, you're serious about understanding how markets actually work. You're not here for hype. You're not here for get-rich-quick promises. You're here to learn structure, to see mechanics, to build an edge. And that mentality will serve you well. Because markets reward the people who think independently, who verify data, who separate emotion from evidence. They punish the people who chase headlines, who trade opinions, who confuse luck with skill. So, if this breakdown helped you see silver differently, if it gave you a framework for watching the next move, hit that subscribe button. Share this with someone who's trying to make sense of what just happened. Because this kind of analysis doesn't show up in mainstream headlines. It doesn't fit in a tweet. It requires nuance. It requires context. And the people who understand it early are the ones who position before the crowd. Stay sharp out there. Think critically. Verify the data. And always, always make your own decisions.